Hey guys, Ralph here from the Endgame Investor, and today I'm going to show you some stuff. And by stuff, I mean where we are on the map of the next UK pension collapse. I don't know exactly where we are, but it's going to get bad. It's much more enormous over here. By here, I mean the United States. I'm not in the United States, but over there, it's like 10 times the size of the UK pension funds, and the numbers are not looking good. So let's go there first, and then we'll go into Neil Kashkari, my favorite Rasputin Fed member. This is an Excel that I did not kajigger. I am not the kajiggerer of this Excel. This is from SIFMA, the securities something, financial something, market something.
Now I got a whatchamacallit instead of a kajigger, you stupid whatchamacallit.
They count all of the bonds that are issued by the federal government. And here is the numbers on who holds them. So this is interesting. You've got here pension funds. How much are held by pension funds? How many bonds, how much treasuries are held by pension funds? 3.3295 trillion. That's almost a record high. It was higher in the fourth quarter of 2021, but the reason that it's going down is not because they don't own more treasuries, it's because the value of those treasuries are falling. And so here we have pension funds. That means public and private pension funds, all pension funds, whether they are in the bloated public sector. It's not the public sector, it's the government. Let's just call it the government. And the private pension funds of a company that takes your money and pretends to manage it and pretends to care about it when all they're doing is stuffing it in bonds. And here in this column, we have what's called a discrepancy. The discrepancy is the difference in issuance versus holdings. So if issuance is higher than holdings, then this number is positive. Negative number means that the holdings are higher than the issuance, which means that's the principal gains in the pension fund across all of everything. So here we have $1.062 trillion of discrepancy, which means that the holdings of treasuries are $1 trillion less than the issuance. So the total loss in principal value for all these funds, for all these invested pension funds, is about $1 trillion. It's against the monetary authority, state and local governments, all holdings of treasuries, down $1 trillion in principal. Now let me show you something a little bit bigger.
100 billion.
Okay, this is from the OECD, the Organization of Economic something Democracies. I don't remember who cares what these things stand for? They're a bunch of idiots. So the OECD, which is the organization of countries that want to be in an organization of countries that make them feel better about themselves. You have the total pension funds, I guess nominal, of all these countries. And here you have, oh, look at that. And UK is right next to the US because they both start with United, because we're all united. Kumbaya. I love that word. Here you have the United Kingdom, which is $3,572,623,000,000. I think this is in millions. Yeah, so it's $3.5 trillion in total pension funds. And here you have, oh, look at that, United States, 22.6 trillion. That's a little bit more, almost 10 times more. Was it 9 times more? 8 times more? About 8 times more, a little less. This is going to be fun when it falls, and it's very close. How close? Oh, well, you see, it doesn't have to be the actual pension funds that collapse. It can come from anywhere, and it's going to come from the weakest link. And since everything's linked up, then the weakest link breaks and the whole chain falls. In 2008, it was subprime mortgages. It's not going to be that again. It's going to be something. It's probably not going to be pension funds, because that's already on the radar of everybody, because, the UK almost imploded, and they'll implode with something else. So what's it going to be? I don't know, but it's all going to fall at the same time. And now let's move to my favorite Fed member, Neil Kashkari, who has the lovely eyes of Rasputin, who is instrumental in doing something in Russia that we dare not speak of. Neil Kashkari, Fed can't pause rate hikes with core inflation accelerating, Kashkari says. Fed needs to see progress on core inflation, Kashkari says. Core services inflation, which is the stickiest of all, keeps climbing, and we keep getting surprised on the upside. Well, Neil, what did you say last year? November 2021. Let's go to that YouTube title. Here it says cash carry in a YouTube video by Bloomberg Markets. Cash carry, Fed shouldn't overreact to temporary inflation, he says back on November 16th, 2021. Well, look at those lovely eyes. You can see them here in this article. Here's his eyes again. You want those eyes in charge of the economy because it means everything will be fine. You can see it in his eyes.
I bring you love.
It's bringing love. Don't let it get away.
Break its legs.
And he's talking about the stickiest inflation. So what is what is the stickiest inflation? Well, we have here the Atlanta Fed, which releases a sticky price, CPI, and all of these little CPIs. They're fun nuances, but none of them actually, there's no one authoritative one that is the best. But here's something that I like to look at, and it is the sticky CPI versus the flexible CPI. The sticky CPI is made up mostly of what is called OER, or owner's equivalent rent, and I'll get into that specifically in a second. But here you can see the sticky CPI, right, as the flexible CPI. And let's zoom in here for a second. Let's make it bigger, making it bigger. And we have here, okay. So the flexible CPI starts to head higher and higher and higher into May and peaks out at 20%. This is like food, energy, very volatile prices and stuff like that. Peaks out 20% March 22 and then starts heading down. Wow, that's great. But what happens to the sticky price in the orange, I think it is? Well, that was 4.7% in March when flexible CPI peaked out at 20%. And since then, flexible CPI has been falling as energy prices primarily have been falling. And since then, the sticky price CPI has gone up 4.72, and then 5.2, 5.8, 6.1, and 6.5. Ooh, it keeps accelerating. That's a problem. And if we go back all the way to here, that's when we'll find the sticky price, sticky price CPI at around the same time in August 1982. Has never been this high in the last 40 years. Oh, that's great. Okay. And now what about owner's equivalent rent? Well, owner's equivalent rent is the biggest part of the CPI, of the sticky CPI. Owner's equivalent rent is a fake, made-up price gauge that basically means people, Federal Reserve interns with a lot of zits on their faces and stuff, teenagers, early 20-somethings, they don't know what they're doing. They're drinking a lot of Red Bull. And they call you up, and if you're a homeowner and you say, well, are you a landlord? And you say no. And then the guy says, well, if you were a landlord, how much would you rent your house out? And they're like, well, I don't know. And they make up a number. And this is the number that they make up. And this is what they count as the CPI. And it's really great economic research. But anyway, it's the highest it's ever been, ever, because they only decided to use this metric that they made up in the early to mid 1980s in order to artificially suppress the CPI to make it look better than it actually was. Anyway, so we have the highest reading back in 1986, April 1986, at 6.64870%. And here we just passed that, 6.68145%. We just passed the all-time high in the owner's equivalent rent, and this is the slowest moving price metric, and they'll probably change it or rejigger it later to further suppress the CPI, but by then it'll be too late and the dollar will be abandoned. So next thing to look at. Remember pension funds? We talked about pension funds. Let's talk about them again. So we have here this chart. Let's make it bigger. Big. Wow, it's so big now. Okay, that makes me feel a lot better.
A noble spirit embiggens the smallest man.
Embiggens? I never heard that word before I moved to Springfield.
I don't know why. It's a perfectly cromulent word.
We have the U.S. 10-year rate. Okay, so a 10-year rate, just to give you an idea of how much funds are losing on this thing. Well, it's now at 4.24%. Fine, so 4.24%, and the last 10 years, it hasn't been nearly that high. So basically, you have this line here, and the highest it's been has been about 3.25. So anyone who owns a 10-year bond, they're way down on it, way down.
Deeper and deeper, way down.
Because rates haven't been this high in the last 10 years. So the last 10 years of issuance for the 10-year have been at rates below the current rate, well below the current rate. Everyone's underwater, and that's a great thing.
Way down.
How bad has it been for bonds this year? Well, let's move to something I did kajigger. Here's Microsoft Paint. This is my favorite artistic software because I'm very sophisticated like that. Here, okay, so I plotted the biggest years of moves in interest rates going back to 1962. Looks like 1962. So here is 1969. The move there was 184 basis points up. And here we had 1980. That was the peak of the gold bull market when gold went and silver went parabolic, 193 basis points. Okay, that was worse. Here you had 1994, the bond market crash of 1994, and I believe my friend Monaco64 Mario was a bond broker during this time, and he can tell you stories about that. Maybe we'll talk about it in our next live stream. 203 basis points higher in the 10-year, and this is by far the winner. 269 basis points 2022 so far, and we have 2.5 months left. Let's see where we go, folks. It's going to be fun. We're back at the lows hit in 1998 here, where my cursor is going around here, and the low here was 4.1%. That was during the last Asian financial crisis of 1998. So we have lost about 24 years of money printing in about 2 years.
Deeper and deeper. Way down.
It's going to be fine. The pyramid's not going to collapse. It'll be fine.
Deeper and deeper. Way down.
Anyway, I wanted to close with Daniel Oliver of Mermcan, who is my favorite gold and silver analyst, who I look up to, and I fawn over his research that comes out every month, or sometimes he misses a month, but he didn't miss a month this time because things are getting real damn exciting. And it's a pleasure to read his stuff. So I'm going to read you a paragraph that might make you feel better or worse, depending on where side of the equation you're on. Everybody calm down, all right? The title of this research paper is "The Final Bubble is Bursting." I know, it's bursting now. You're not going to rebuild it. October 18th, 2022. I am not the only in-game investor in town. Daniel Oliver is also an endgame investor. He just goes by the name Mermican, which there's like an ant here. Is a Mermican an ant? I gotta look that up. I don't really know. He says, it is the UK that likely shows the way. There will be some accident, whether with US pension funds or in the repo market as in September 15, 2019, or when Japan starts to dump its hoard and others try to front run it, the US Treasury complex will collapse.
Oh my God, Dr. Swanson!
We know this for the same reason that Mises, Ludwig von Mises, knew that credit bubbles cannot last forever. And finally, he says this: the Treasury bubble is the final bubble. The final bubble. It is final because US Treasuries are the backbone asset of all important central banks. The Fed had already suffered $720 billion in losses on its $8.7 trillion portfolio as of June. And he shows the numbers in this little footnote. If you want to look it up, I'll give you the link in the bottom of this video. $720 billion in paper losses on the Fed's balance sheet already because their balance sheet is stuffed with bonds. And now they have operational losses, which means they keep booking losses in the quarter because they have to pay interest, and they only earn very low interest on the bonds that they already bought, and they pay higher interest on the liabilities that they have, mostly at the reverse repo facility, which is like $2.5 trillion or something like that now. In the final paragraph, of which I agree wholeheartedly, and we are nearing the end of this, like the water draining ahead of the tsunami, gold has been crushed by the US dollar margin call along with every other asset class. Yes, people have to sell everything in order to get their hands on dollars so they can stay solvent, because it is the dollar that still runs the monetary system. But this will not go on forever. Final sentence: it has been tough for the past 2 years. That's a typo. I think it means it has been tough for the past 2 years, but the final bubble is under stress. And once something big breaks, the tide will turn dramatically. And so when the tide turns, we will all know. It will be on a day when rates in the bond market go crazy or something, like exactly that happened in the UK when rates on the 30-year gilt, I think, went up some crazy amount, 50, 60 basis points in a day. Same thing's going to happen to the Treasury market. And the Fed is going to step in despite what Neil Rasputin Kashkari says with his eyes of love.
I bring you love.
It's a monster!
They're going to buy the bonds to save the dollar pyramid. and then the public attack on the dollar will commence, and people will spend it as fast as possible, and gold will begin to rise up to balance the Fed's balance sheet by force, where its liabilities will be balanced by the gold value on its balance sheet. And that is somewhere around $30,000 to $35,000 an ounce, and we'll get there quickly once we're on the way. This is Rafi of the Endgame Investor. If you enjoyed this video, consider subscribing to a 2-week free trial of the Endgame Investor, because once the Endgame kicks in, I don't know if it'll actually be working anymore. So you might want to read what I have to say before it actually happens. Or you can become my patron on Patreon, where you will get a biblical themed video commentary on economic policy, monetary policy, and governmental topics, on various Bible stories, etc., where we can learn from culture and logic where we're headed today.
I'm for a booster!
Good morning, starshine. The earth says hello.